Hello everybody and welcome to the Cyclical Investors Club YouTube channel. Today I'm going to do a pretty quick analysis of VF Corp. This one came in as a request down in the comment section. So if you have a request from a stock that's in the S&P 500, just drop it in the comment section. I'll get it on my list and I will eventually make a free YouTube video analysis. And if you have a stock that's not in the S&P 500, I post those over on Patreon, and if you join there, it's $5 a month, and then you get a big discount to my full service Cyclical Investors Club over on Seeking Alpha, where you can see all these spreadsheets and stuff that I show people a little bit of for each stock when I'm making these videos. And then you can also chat with me any time of the day. And you can read all the theories behind my strategies, and you get access to additional strategies and the ones I typically make videos about. So there's a lot of good stuff over there. And it's going to come into play for certain with a stock like VF Corp. I think this is one where most good medium-term analysts should have been warning people off this stock for a long time now, honestly. Now, if you're trying to play like a short-term bounce like we see coming out of COVID here, that's one thing. If you're some sort of technical analyst, they would never have been buying this all the way down anyway. But if they were, that's another thing. What I try to do is focus on buying high-quality businesses, looking out 2 to 5 years or longer sometimes, that are trading at good valuations low enough that I can hopefully get above average returns, even accounting for the ones that I get wrong. So that means I'm usually trying to buy stocks when they're pretty cheap, but I never want to sacrifice quality. And none of my strategies sacrifice quality. There's always going to be some that are on the border that are going to do worse than expected, but you never want to I don't start off usually on purpose with like turnaround stocks. So that's one type of stock that I don't really, I used to, but I just didn't have good results. They weren't always disastrous, but usually the flaws in the business were harder to fix and took longer than you would normally expect, which costs you money. Even if you don't lose a lot of money, you could have been making it. So that wasn't an area I found I had a lot of talent in. So I really focus on the quality end. And then typically, if it's not a deep cyclical stock, I'm focusing on earnings as my primary metric, especially future earnings power. Now, I might use other metrics to try to look at it from different angles, but really earnings is what I mostly care about in most situations. So for me, when I look at VF Corp, which is for now still in the S&P 500, if they haven't already announced it, it's going to be gone. They'll be replaced by some other. I have a few in mind that I think might replace it, but I'm not going to say those right now. But it's gonna be gone. But investors could have seen the problem such a long time ago and that's what I'm going to show you now. Okay, I'm going to show you the metrics that you need to look out. So let me begin by saying, if you look at VF from like 2002, I think, which is when this goes back to, or 2003, up through the end of 2014. Okay, this is all really good and looks like a very high quality business. And buying the stock anytime during this time, if you got it at a reasonable price, definitely in here when it's 13, definitely during the Great Recession when it was like almost free. Then when we get up here after they've had this big run, you can see that they get more people notice it. They get more popular. That other Kramer dude on television starts pounding the table and telling everybody buy, buy, buy. And if you go back, I guarantee that's what he was doing right in this time. Because they have a track record and everything's going great and everything looks fine. That's fine. I think up here when they were getting into the 20s, maybe the valuation probably shouldn't have been buying, but you wouldn't have necessarily sold If they're growing, let's see what they were growing. If they were growing earnings at, let's call it 15% through here, and with a 23 PE, that's a hold still in my book. But we see the problems come, and we actually see the market totally recognize those problems as the stock price starts to come down here in 15 and 16 and 17. So here's where you should be reassessing things. And the metric that I used to do that, I didn't own this stock, but let's just say that I was super smart and I bought it down here at the bottom. The metric you want to watch, that I watch, I would say, is the 3-year revenue. Like where was revenue 3 years ago compared to where it is now? And if it's lower now than it was 3 years ago, and we're not like in a recession, or there's some obvious explanation for it, COVID, or maybe they sold part of the business or whatever, so revenues are naturally going to be lower, but they got the cash for it. If there's like a simple explanation that's not just an excuse in the story, then if there's not a reasonable explanation, then I sell the stock. So when I was looking back, I thought, well, the business looked good, all this stuff looked great. So people that bought this were really smart here. It's another reason not to buy and hold kind of more mature companies. You should always be kind of paying attention to what can happen, because things can deteriorate, especially in, I think these guys are like apparel, right? Yeah. I want to say it's North Face and Vans, and they have a bunch of brands. But so the metric is the 3-year revenue. So if we look at that, see, I posted it here somewhere. Okay, so this is going back to mid 2016, going and looking back 3 years to mid 2013. And at this point, revenue growth in 2016, halfway through, was lower than 2013. This is when I would have sold, because I don't see any explanation for that sort of a decline in revenue at this time that jumps out at me. We're mid-cycle. We weren't in like a recession. There's no reason really that it should have done that if they were on a track of medium-term growth. So if you look at the stock price, Wall Street absolutely understood this. They sold the stock off from, well, when was I measuring it? Like back here? From the top down to halfway through, that's 2017. So that would have got you out right, let's call it there. All right, so you wouldn't have been selling at the top. This isn't like a market timing thing. This is sign that the business is not growing at the rate that a high quality business should be growing. And it was trading at a 25 PE or a 20 PE with falling revenue, 3-year revenues. Every company will have blips on revenue. And so you don't want like just to take 1 year, because then they have a little hiccup of some kind, and that's fine. And then if it's a bad recession like in 2008, you expect revenues to come down. That's like not anything internal to do with the business. That's just like the macro economy. But when you're in the middle with no recession and your revenues are lower than they were 3 years ago, I sell. And that simple rule has saved me so much money. It's not even, it's so simple. You have to use some human judgment, but it's very simple. And if you follow that, now, just because, did I change my thing? Let's just go to here. So now, just because you sold, a lot of people will look at what the stock price does afterwards, and they'll say, oh, you were so dumb or whatever. You could have sold up here. The stock price, you sold and the stock price went up. Well, let's just say that's the case. So it might have risen 100%. Actually, hold on. Let's see. Let's just see. Say you sold here. If I can get my fast graph to work, which it's not. Okay, it's not going to do it. We can glance at it though. So $58 to, yeah, so up, what, 40%? We'll call it 40%. And, or more than that, it was actually more like 50 or 60. So somebody will look at that and they'll say, oh man, you shouldn't have sold. Well, you should have sold because there's no way you could know that the stock price would just take off again. The next year, earnings growth was basically nothing. And then this part of this goes into 2019, but this year we had tax cuts, right? Corporate tax cuts. So they get a bump from that, and that's fine. That's real money that they get to keep, but it's not anything the business was doing good, right? In order to do that. And then we get into 2019, which is right here, and we can see that once you take out that tax cut bump, their trajectory was going down. And then we can blame this on COVID, that's fine. But even going in there, the trajectory was flat to down. So the people that didn't realize this was a one-time bump from tax cuts got burned. But you got the clue way back here in mid 2016 that this wasn't a high quality business anymore at that time. And you had a few years where there was a trend. It wasn't just a one-time thing. So for me, I'm out there if I had held the stock during all this time. And when you look more recently, I actually have this one in my spreadsheet just because it's in the S&P 500, and I try to do a valuation on the S&P 500 sometimes. But I would not even follow it otherwise. Now, right now, the 3-year revenue is positive, okay, because we had this COVID stimulus money bump right here, and we're going back like 3 years, so we're kind of measuring off the bottom here for revenues. So revenues have gone up, but we can see that the earnings growth during this time is negative, and this is from 2015 probably. So yeah, from 2015. So you go all the way back to 2015, and you can see it on the fast graph. I mean, it's obvious. So you go back to 2015, which is up here, and you look where earnings was, right? $2.90 a share, and then last year they were $2.10, and there's no excuse for that. I mean, there's no like reason for it other than the business is deteriorating. So again, this is really like a 5-second analysis. I mean, I could just look at the fast graph and be like, okay, I'm just not going to buy that. Like, the trend is down. This isn't a time where things are super cyclical. The only reason they got this bump was because of COVID stimulus. So you just look at it and you say, look, that's just an avoid. Earnings growth is negative. I don't buy stocks where earnings growth is negative unless it's like a down cycle or something. So I'm going to title this something like for dividend. They cut. The reason I'm doing this article a little earlier, because I just got this request a little while ago, is because they cut their dividend and now the stock price fell like 15% or something. Yeah, it's down like 15% today. And the thing is, if you're focused on only dividends, which a lot of people are, and I'm going to show you my example here from over on Seeking Alpha. I just put the buys and strong buys up. And this isn't against any of these analysts. I make mistakes when I analyze companies too, but what I want people to focus on is once you own like a dividend stock, if you're looking to make sure that it's going to pay its dividend, you need to watch revenues and you need to watch earnings. You don't need to be watching the dividend. The dividend is going to be the last thing that goes, and by the time it goes, which people are finding out, you're going to lose like 90% of your money. So when I look at these I'm just going to look at the titles, right? Because we can tell like who this is being marketed toward. 6% dividend yield. The safest dividend is one that's just been cut, right? Speculative dividend play, right? That idea there is like everything is horrible, but the dividend might be worth it, you know? So let's see. Don't take the reduced dividend for granted. It's a buy, right? I mean, that sounds like it's not, but it's all dividend focused. So they're not all dividends, but there's so many of them And then, of course, if you read them, I'm sure more. Here, so 50 years of dividend growth, right? More and more. China, that's probably pretty important too. 6% yield is too cheap to ignore. Don't join the panic sellers, right? So here we go. 7% yielding dividend king. That's the type of thing. Okay, more dividends. Yield surge. I promise you that's not the earnings yield. That is the dividend. Another dividend, right? Okay, I think I made my point here. So I have a dividend investing strategy. If you watch my Texas Instruments article that I did a little while ago, I explain it. Now, I hardly ever do anything with the dividend strategy lately because all the dividend stocks are overvalued, and they have been for like 2 or 3 years. So longer than that. During COVID, you could pick some up, like in the March 20, like in 2020, excluded. These dividend stocks have been overvalued since at least 2018. So almost every single one of them. But people were really hungry for yield. And so they were really, because so many boomers are retiring and they all wanted yield, but were no bond yields available, right? So people were looking at dividends, okay? Which makes total sense. But now bond yields are like, you can get I'm getting 5.5% on cash. That's more than all these dividend stocks still pay right now, except for the really bad ones that are about ready to do what VF Corp just did. And then what will happen is the dividend gets cut. More people sell, which we have evidence of today, 15% down, so you know people are selling. We pretty much know it's because the dividend got cut, and we know they all lost money, right? A lot of money. So it's okay to have a dividend strategy, but there are going to be times, and now is one of those times, where entire strategies, I wrote on SCHD, I'm going to do a video on it too, because this is the point I was trying to make to everybody. It's a good dividend strategy ETF, but the whole universe of stocks that they select from are overvalued. And if these bond yields and cash yields stay where they are, it's going to lose money. It might not lose it really fast, but it's going to lose money. So because the earnings and revenues, I try to show people with the revenues, similar to what I'm doing with this particular example, but I could take the whole list of them and the revenues are weak. That's a sign earnings are probably going to get weak. And that's a sign the dividend is probably going to suffer, but not before the stock price falls in half. So it's okay to look at dividends. You can use dividends to value stocks like I did with Texas Instruments, but if you're really just focused on the dividend, there aren't any to buy right now. And nobody wants to tell anybody that because people that like dividends read articles, they watch videos. If I put dividend in a title, I get twice as many people to watch it or read it, you know? And so when those eyeballs and those investors are out there all looking for dividends, you know, I mean, you can't blame people for catering to that audience. I mean, I don't do it, but the temptation is always there. I mean, I'm basically just leaving a bunch of money on the table by not catering to dividend investors, even though I have a dividend strategy, you know, that's probably better than most of the other dividend strategies that are out there. But sometimes there's nothing to buy unless you want to lose money. So that's it. I hope look at that 3-year revenue. Apply a little bit of thinking to it to ask whether it makes sense, if it's business specific or if it's kind of a macro thing. And if it's a business specific and there's no good explanation, those are stocks to sell, right? Or you're going to end up probably, I mean, some businesses have turnarounds, right? But they can take a long time. So for me, I just sell and I go find something else to buy. And right now, cash yields 5%. So, I mean, you can take your time. That's my feeling. Looking for something that remains high quality and you can get a decent price. All right. So members of the Cyclical Investors Club know all this. They could go to that spreadsheet, look at VF Corp, see earnings were negative in about 3 seconds, and then kind of go on with their day or think about it a little. At least think about it if they already owned it. And there's a whole bunch of other stocks like that there too. So consider joining that. Hit the subscribe button if you want more videos. Drop your requests in the comments, and I will make more videos. Later, everybody.